Strong stock market is a negative sign because all the economic strength that we've seen, or all the stock market strength that we've seen, has been precisely because the economy is weak and because investors expect it to get even weaker. And so that means that as bad as these leading economic indicators have been, they'd actually be worse.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
I was talking about the leading economic indicators, which have been a disaster. We got the last or the most recent one, which was way worse than estimates. I think triple what had been forecast, minus 1.2%, or minus 1.2. And it was the 12th consecutive month where these leading economic indicators were down. I mean, so what does that tell you? Because these are forward-looking numbers. It says the economy's not looking good, right? I mean, you had to go back, I guess, to the Great Recession of 2008 to find a string of negative leading indicators as long as this one, right? So it doesn't have a good precedent. Well, the numbers would have been even worse had it not been for one of the lone positives, and that is the stock market. The stock market has been going up over these past 12 months. And the stock market is a leading economic indicator because it is forward-looking. And so when they put the stock market into this series of leading economic indicators, it was because it was believed that a rising stock market signified good things to come in the economy, that investors were looking forward to a stronger economy that would deliver stronger corporate earnings. And so when the market was going up, that was a forward-looking indicator of economic strength. Conversely, if the stock market was going down, that was a negative indicator because it meant that investors were worried about the future. They were worried about falling profits, and so they were selling stocks. And so the movement in the stock market was seen as an indicator of future economic growth, which is why it is a leading indicator. Except that's not how it works anymore. It's actually the opposite. The stock market goes up when the economic data is bad. Bad news is good news for the stock market. Now, why does it work that way now? Well, because when investors think the economy is bad, they get bullish on stocks because that means the Fed is going to be easier. Maybe they're going to start cutting rates sooner. Maybe they're going to go back to quantitative easing. So when the stock market goes up, that's actually a bad sign. Investors think the economy is weak. Conversely, when the stock market is going down, it's because of good news. When investors think the economy is going to be strong, they want to sell stocks because they think that means the Fed is going to have to hike rates more or leave rates higher for longer. That's what's going on. So one of the lone bright spots in the economy is actually a negative, but it's not being counted as a negative in the LEI. So they really should change the LEI so that a weak stock market is a positive sign for the economy and a strong stock market is a negative sign because all the economic strength that we've seen, or all the stock market strength that we've seen, has been precisely because the economy is weak and because investors expect it to get even weaker. And so that means that as bad as these leading economic indicators have been, they'd actually be worse if we were accurately counting the stock market as being a negative indicator as opposed to a positive indicator. And now for a new topic, but on this topic of the stock market, I have been talking about on this podcast for a while how a lot of the money-losing companies that were born during the era of 0% interest rates and quantitative easing would die as interest rates normalized. And we got another example of that late this week. I think it came out Friday, maybe after the close, but the stock was down 11%. Maybe it would have been down more. I'm talking about BuzzFeed. This is a internet news organization. The kind of parent company which created it owns the Huffington Post. So it's a very left-leaning news organization. And they actually went public through a SPAC back in 2021, almost 2 years ago exactly to the day. This thing went public through this SPAC at $10 a share. And I remember on the podcast, I talked about it. I don't remember which episode, but I spoke about it, and I made fun of it because I said, look, this was a ridiculous IPO. The company's never made any money, and it probably never will, yet they went public anyway. And even when it went public through this SPAC, it never even traded at $10. The high, I think, I look back on the charts, was $9.97. BZFD is the symbol of this stock, and it closed at 67 cents on Friday. So it was already down better than 90% from its debut with the SPAC. It was down 11% on Friday. So clearly this is not a shocker that the company is going out of business. The market obviously anticipated that. But you basically have a company going from the equivalent of an IPO to a bankruptcy in 2 years. What a disgrace. I remember talking about the fact that money-losing companies should not be going public. 2021 set a record for the number of money-losing companies that went public. But back in the day, whenever that day was, Wall Street wouldn't dream of bringing a company public that didn't make any money. I mean, I think that started during the dot-com bubble. That's probably the first time where this, concept happened, where people would buy money-losing companies and gamble on the IPO. Because an IPO normally would happen, and again, back in the good old days before the Fed turned the stock market into a casino. But a company would go public long after it proved the viability of its business model. Let's say I had a business and I was making good money, right? Because the businesses that don't make any money, right, they fail. Those aren't the businesses that are supposed to go public. The public's not supposed to invest in a business that hasn't even proven itself. So let's say I've got a business and it's doing well. I'm making money. I've been making money for years. And now I want to take this proven, successful business model and I want to expand it, right? I want to grow my business that is already making money. I just want to scale it up. Now, how do I get the money to take a profitable business to the next level? Well, one way is to go public. I am going to let mom and pop investors in. They're going to get a piece of my action. They're going to give me some of their money, and I'm going to invest that money to grow my business, right? I'm not trying to cash out. No. I just want to raise money to expand. And I'm not really selling any of my own stock. I'm going to be the biggest stock shareholder in this public company. And of course, since I'm the biggest shareholder in this public company, I'm going to really make sure that I do a good job. I've got all this skin in the game. I'm just, tapping into the equity markets, and I'm going to scale it up because it already works on a small scale. I just need some money to take it to the next level. Like, that's a legitimate IPO. But based on the Fed turning the market into a casino and Wall Street happily playing along, the whole IPO market changed. And that by the time a company goes IPO, the original investors are cashing out, right? These venture capitalists, these guys that did the seed money, they're the ones that get in early, and then they use the SPAC or the IPO to cash out and to sucker in the public with the help of Wall Street into buying these worthless companies. And that's what happened with BuzzFeed. Some of the founders took a lot of chips off the table, and then they're playing not with the house's money, with the public's money. They cash out, right? That's their exit strategy. And you have the public being conned into buying into a pig in a poke. You're buying a business that's never made any money, and you have no idea if it's ever going to make any money. But nobody cared because money was free, rates were zero, investors would buy anything, including BuzzFeed. And here we are 2 years later, and every penny that the investors put into BuzzFeed has been lost. The company is at zero. It's laying off its workforce. I think some of the people are going to get, reassigned to, Huffington Post, or, they won't all be out of a job, but a lot of people will be out of a job. And this is just one domino. There's a bunch more that are going to fall. Again, I said 2021 set a record for money-losing IPOs. And I said back in 2021 how quickly a lot of these stocks would go from IPO to bankruptcy, and it's already happening.